Ladies and gentlemen, I hope you are having a great time so far. Let me introduce the next session, Risk Management for Turbulent Times. Join experts to learn what challenges the industry is facing, what solutions are most effective, and how to prepare today for tomorrow's market. Please welcome on stage the moderator, Raj Sitlani, Managing Director at ISAM Capital Markets.
Good afternoon. Nice to be here for a second time in a couple of months that I've been a moderator. Hopefully it's going to be interactive and exciting. Maybe we just start with going around the panel, and if you give yourselves maybe a minute to introduce what you do and what you get up to, and then we can start heading some questions. Cristian, why don't we kick off?
I'll head that. Hello everyone, good afternoon. My name is Cristian. I'm the CEO of Centroid Solutions. Centroid is a technology provider headquartered in Dubai and servicing retail brokers with their core technology needs. We offer a real-time risk management system, bridging and connectivity, and also hosting solutions. And we've built the solutions over many years such that they are suitable for a wide spectrum of customers, all the way from starting brokers to large institutions, liquidity providers, running multi-asset offerings. Thank you.
Hi, I'm Maria. I am the Business Strategy Manager at Plugit. We are a technology solutions provider in the FX area. We have been established since 2012, so it's also our 10-year anniversary as well as FMLS, so we're celebrating that. Over the 10 years, we've helped brokers grow and develop, basically, with regards to our products, our modular solutions that we offer along the lines of dynamic margin, which is one of our premium products in risk management, as well as the others along the lines of introducing brokerage affiliation portals, our copy trading module as well, CRM, and bonus automations. Thanks.
Michael.
Hi, everyone. Good afternoon. My name is Michael Kamerman, and I am the Group CEO of Skilling. Skilling is a Scandinavian fintech that was commercially launched just a few years back in 2019. Skilling offers all the proprietary technology that we need to grow a successful fintech. We offer proprietary desktop platforms, mobile platforms, back office, partnership portals. We also offer licensed platforms like Spotware products and MetaQuotes. Since Skilling is a relatively new brand, I'll give you our differentiating factor. We know our clients really, really well, but to not just pay lip service to that, our top markets are Norway and Sweden, since we are a Scandinavian brand. And to give you some detail on the way we carry this strategy out, in Sweden, you can fund your account in Swedish krona. You can trade Swedish stocks. You can verify your identity using Bank ID, which is a national identifying service for Swedes. You can watch us on Swedish YouTube channels. We sponsor Swedish sports. We integrate with the tax authority, and we are launching a tax advantageous account for the first of our type in Sweden. That's our strategy. Go all the way down, understand every nook and cranny that a client wants for all client types, come back up, build a product line that suits those clients. That's Skilling. Thanks for having me here today.
Despina.
Hi, Despina. I'm Chief Risk Officer at the Match Prime Liquidity. We are a CISAC-regulated company. We offer liquidity to brokers, institutional clients. Together with our strategic partner, Match Trade Technologies, we offer a full suite of product with proprietary platform, bridge solutions, and liquidity. And we cater our clients' individual needs. We can customize and according to the client's requests. Thank you.
David.
Hi, I'm David Shayer. I'm CEO of Vantage UK. We're a multi-asset broker, part of the wider Vantage group. We're FCA regulated here in London, and we've just launched today the Vantage Connect, moving into the institutional space. And we're the ones with the big McLaren car outside, if you want to take a look. So thank you, and good afternoon.
Okay, well, look, I mean, we're here to talk about risk and risk management. I think it's probably safe to say that Q3 of this calendar year has been a very profitable one for retail brokers. October, I think, by all accounts, we're hearing people have had a bit of a wobble, and November is looking a little bit like October. What we have seen really is people making a lot of money in Q3, the retail brokers, and potentially spending it rather unwisely in a sort of war on pricing. There have been spread caps flying around. People are marking prices down. It looks like a race to zero. And I think they're coming a cropper at the moment. So it'd be interesting to sort of understand from your perspective as a panel, do we think that the psychology of the risk desk at the retail broker is very short term? They're riding the waves. When they do well, they do well. When things start to go a little bit ugly, there's a change in the risk team. The CEO gets a bit unhappy. What's the general feedback in terms of should we not be looking at retail brokers, or should retail brokers not be looking to normalize their P&L over a longer period of time rather than try to be short-termist in their approach? Maybe David, I can start off with you on that one.
Yeah, at Vantage, risk management is actually, vital to us. We've built our own in-house systems. We were big enough that we can, we've got a lot of real-time data. We can drill into that data, slice and dice it, and get that real-time information. So we're looking very much the long term and how to protect our book and manage our risk. It's absolutely vital. Smaller brokers, they may be using, third-party systems, but here at Vantage, we're using in-house built systems, and we've got that data, and it's all about, what good data you have, the quality of it, how you can slice and dice it, and look for the long term and protect your book.
Thank you. Despina?
Yes, sorry. So I would say that, yes, indeed, we've seen a lot of changes. The market has been very volatile during the last quarter. And I believe that, indeed, the risk team, sometimes they take too short-term of a view. It all needs to be like taking into consideration all the cycles of the market environment. So they need to adapt their risk strategies while the environment is changing. Obviously, the size of the broker matters for sure. If a broker has a very big balance sheet, they can sustain the losses, they can have a more long-term view, and they can wait for different effects that will cause better revenue to them. So it all depends on the broker strategy. They need to have a strategy. They need to change it and adapt it accordingly. And the risk team, for sure, is very important. They have risk tools to have to identify all the problematic flows. That's it.
Michael?
I would build off of what David said, but Skilling is not the cheapest broker out there. We are not trying to be the cheapest broker. We are not trying to compete in the bloody waters of price wars. That is a race to the bottom. Instead, we're trying to offer competitive pricing that adds more value. We are not subject to, we are opportunistic in the full regulatory and legal way. We are enjoying that heightened volatility is bringing higher revenues to us, yes. But we are not trying to make any short-term decision for long-term peril. To give you something to bite into, to make this a little bit more concrete, we actively follow the correlation coefficient of our client's performance versus our performance, and over the 3-year, over a 3-year time horizon, because we're a relatively young brand, that there's basically no correlation, meaning we're not running up in our performance if our clients are having a tough time, and vice versa. Negative correlation would be minus 0.1. That would mean if clients do well, we do not do well. A positive of 1.0 would be, if they do well, we do well. Our 3-year average is 0.18, which means that we're not reliant on the client performance. We're trying to build a longer-term brand offering better solutions, which I articulated already. And so that we don't make those short-term decisions. We don't face that risk, but it doesn't mean we're not opportunistic in trying to find additional revenue where it lies.
Thank you. Maria?
Yeah, I tend to agree with Despina on this one. I think that it doesn't necessarily depend so much on brokers taking a shorter view. It's definitely, it kind of has to be a balancing act, right? I mean, it's something where you're saying in these turbulent times, and it's come to the point where brokers are also in a situation where it's not so easy for them to be able to say what they can expect, what they can't expect. And when it comes to risk management, it's pretty much that you're looking at different patterns, being able to profile your customers, being able to look at different situations. You know, okay, events are coming out, central bank announcements, being able to know that there will be high volatility during those times, and being able to have the right tools to be able to say that you can set those profiles, set those criteria to be able to take advantage of those widespreads and limit your exposure, obviously. And as I said as well from Vantage about your A book and B book and how you're profiling those customers and how you go about hedging yourself.
Christian.
Right. Well, I agree completely that it's very important to have the right tools to react, right? And that's basically what we are trying to provide to the market. And I believe that we have a pretty good insight in this regard, as one of our products, it's a real-time risk management system. And what I've come to see actually, and what I can say with certainty, is that across the many customers that we're servicing, which are of different sizes, it's really interesting to see that not two customers are actually following the same approach. This is something that is quite interesting, because on our side over the years we have built a lot of tools. We're tracking a lot of different parameters automatically, and out of this it's very interesting to see that different customers are using completely different methodologies when it comes to risk management. If we talk about specifically the smaller entities with smaller balance sheets, they might be forced to prioritize, let's say, the short term rather than the long term, in order to maybe offset the initial investment costs and so on. However, I find that very, very risky, and I've seen that firsthand. And it's very important to follow a more sustainable approach and focus on the long term, basically, and take only the level of risks that you are able to manage, basically, based on your balance sheet.
Okay, so I mean, look, we're talking about risk desks quite a lot, and I think our experience, certainly one of our group companies, ISRA, IS Risk Analytics, we're helping a lot of retail brokers understand the flow that's coming through, and hopefully we're giving them some good impartial advice about managing their book and understanding their profitability. What are the panel's sort of comments on the fact that many risk desks probably can't work out how much money they're making on risk? They know what they're making in commission, they know what they're making in markup, but actually identifying whether their risk management process and philosophy is actually translating down into the bottom line. Maybe, Christian, you can take that one to start off with.
Sure. Well, I think it's very, very important to understand what are the P&L drivers, basically, what makes up your P&L. And here again, I think there's a big difference between the different type of entities. If we are to talk about well-established brokers that have been operating for many years, I think it's fair to say that they've really understood what makes up their P&L. And in fact, you can see this in some publicly available financial reports of publicly listed companies. However, when it comes to your average smaller retail broker, I would venture to say that it's completely not the case that they know exactly from where their P&L is coming from. And
is that not slightly concerning?
Well, it's very concerning, and actually we consider this very, very important. I think one reason for it is that, you know, the retail trading platforms that are widely used actually do not provide any details, any insight into this. You just see the number at the end, but you don't know exactly where it's coming from. And on our side, we have put a lot of emphasis in breaking down this number and actually showing what are the different drivers. For example, P&L on spread, commissions, swaps, and of course, the risk P&L, or how we call it, the principal P&L. And in this regard, actually, we've also run quite a lot of analytics. And here we went on a bit of a longer time frame just to see what's happening like that. And we've seen that actually it's very important to maintain and to grow basically the spread revenue. That's from where you can get very stable month in, month out revenues. And this allows a broker to plan their OPEX, to make sure that they plan their expansion plans and so on. if we talk about the principal P&L, how we call it, or the risk P&L, actually what we've seen is that it's very, very volatile. So in some months, you can maybe get outsized returns in that regard, but in others, it can dip very much into negative. So it's not very, let's say, reliable. And if we zoom out on a bit longer term, what we've seen, at least from the case studies that we took, is that the spread revenue completely outweighs actually the risk revenue, and it can make up to 70 or even above 70% of a broker's revenue.
I think I would add to that. To go on what Cristian said, we do measure this as a relatively young brand, and I would be surprised if most brands do not measure this. There's a lot of BI tools that can feed this information to you so you can make decisions. But I think he made a good point, which is, as a leader in the company, focus on managing what you can control better. So that we're all here in 2 or 3 years, we have to work out how to manage the risk-free part of the revenue. And so we do monitor the revenue we get from conversions, from FX conversions, from swaps, from commissions, from spread, from risk. We measure all that. And the overwhelming majority since our inception has been from risk-free revenues. We're not looking to bet the farm and collapse overnight. We're looking to run a long-term company. But the way that we're managing the what would we just call the A book, or the risk-free element, is just to work on things you can control. So understand which products do you make the most money on, which products do you make the least amount of money on, which clients trade those products, on what device type do they trade these instruments, what geography do they use, what acquisition channel did they come from. Once your team knows this information, you can then emphasize those parts of the business. Focus less on the low-value client who's trading euro-dollar all day, who's really profitable. Focus more on the client who's trading Solana CFD or trading an equity. Find out why he's doing that and find out what you can do to get them to trade more and more. As you can manage your A-book better, you then are building a more sustainable business. And you're also proving to yourself and your team that you can increase the amount of money that clients will pay to use your product. That's because the A-book is the true value. It's the price clients are willing to spend to use your platform. And so we're spending more time. We know these numbers. I can't tell you in this setting, obviously, what percentage we make from risk. I know it for every year we've been in operation, but it's less of a focus for us. It's more trying to manage that long-term A-book number up.
Anyone else want to comment on this?
I mean, the bulk of our revenue at Vantage is the risk-free P&L. You know, the swaps, the commissions, the spreads. You know, it's again, I mentioned earlier, it's all about the data. Having that quality data that you can really drill into, slice and dice, really understand your P&L, and the more you can get that real time and understand your business and your long-term vision, the better. But we're trying to build a long-term business here at Vantage and understand our risk-free P&Ls. It's where the bulk of our business is.
Okay, so I guess one of the questions has got to be, if Cristian's giving us percentages of 70, 80% on the A-book, why are people B-booking? What are they seeking to achieve, given the volatility and risk profile they're taking on?
It seems like an obvious answer. Short-termism, quick profits and there's companies that do that. And as a younger company, they probably face more pressure to, pay down investment and become profitable. And that's not our MO, but that's probably the MO of a lot of companies out there. It's a quicker way to potentially higher returns, but also, blowing up.
Way to go to dust. Really,
yeah, exactly
probably.
right.
Yeah. So we talked a little bit about. Oh, sorry, Despina.
Yeah, I was going to add that a lot of brokers, they start the operations and they spend a lot of money on marketing, and the acquisition cost of the client is very high. So in the short term, in the medium term, they cannot recover this cost. So they are looking for ways to make more revenue. And because of the very competitive market on the spreads, they tend to focus on the risk P&L sometimes to be more. It will be a faster way to get money, but not always the case. And it's need to have a good policy and to arrange everything in the that.
Maria, have you got anything on that one, or?
No, for us, what we tend to see with our customers, obviously using our dynamic margin tool, they're pretty much kind of trying. What we try to do is help the broker understand what is their risk management model. And again, it comes down to them profiling their clients. And like we said, if it is that they're profiling customers, being able to understand if they're taking more of a hybrid model and saying that they'll push them more over to A book, B book, depending on their styles. And then from there, being able to obviously say that with the tools, properly set up correct criteria to be able to capture, like we said, limit their exposure more, but obviously capture on the spreads that the guys were talking about as well. So, yeah.
Okay. I talked earlier about the race to zero in terms of spread compression. We've seen it across the board, the spread caps and the markdowns. How long is this scenario going to last? And what tools are being provided out there to help the risk desk understand whether they're being abused by offering this arguably fictitious price?
I feel like that's you, Christian.
I don't have much to add on that, actually.
I would say these wider spreads, all that we're seeing, the constant news flowing into the markets, that constantly moving the markets, depending on the event, depending on the news that's coming out. Usually, obviously, central bank announcements, your any interest rate hikes or things like this that we're seeing so much of. Those are expected. I mean, you would know when to be able to capture anything like that. Seeing anything where any of the central banks are interfering as well with policies as well, trying to take advantage. I think we saw recently that Japan and the UK, what with the UK in September, I think buying up gilts, trying to also help strengthen. Those kind of situations where we do see interference, you'll expect that those wide spreads continue. You would be able to then say that again, with the right tools, knowing that those events are coming up, being able to then set the criteria to be able to say, right, we're anticipating this, and it continues. Now, with regards to actual economy and seeing how long all of this would continue, again, coming back to interest rates, coming back to euro dollar, seeing how all of that's reacting. Interest rates, again, being at 4%, we tend to forget, okay, that all these hikes, but now it's trying to get a control on inflation, let's say. But we tend to forget, at least here in Europe, that 4% was at some point considered normal, and maybe that this is the market's kind of way of saying that this is us returning back to normal, and we shouldn't be looking so much at seeing that things will change that much dramatically with regards to interest rates. But that being said, it cannot be, for instance, even in the US, that the Fed would then take their foot off the pedal, let's say, at this point. I think they kind of have to follow through with what it is that they need to do, even if there is any other rounds of increased interest rates, making sure that they follow through to be able to say that all their hard work of what they've done until now doesn't just ease off, because I think they'll lose even more face if that's the case coming back later.
Okay, I think my question possibly got a little bit
Sorry,
lost.
a bit long-winded.
No. I think look, I think we know that interest rates have been rising. We know that means the street itself is pricing more defensively. It's much harder to go out to the big market making banks and get the sort of tight spreads that we saw a year ago. And my point is, in order to compensate for the tighter spreads on the street, it would appear that retail brokers are using other tools and mechanisms to offer pricing that is simply not sustainable, because it is almost choice, for example, on Eurodollar, or even sometimes even lower. I mean, I know there's some technology that can prevent someone showing a negative spread, but I think our concern within the business that we're looking at is how many of these retail brokers can continue to use tooling, which they can go and buy off the shelf, and allow them to offer pricing that is simply just not sustainable. That's the bit that I want to try and get to. And at what point and how much money are they going to lose before they decide this is not a sensible way of managing the flow that we're receiving?
To offer good pricing is people are maybe offering negative spreads or amazing pricing, but it's all about execution, because you can offer the best prices in the world, but if you can't execute on them, then it's just useless. So I think that's what traders are looking for, is not just good pricing, but be stable execution. They can actually hit those prices, and it's not just offering the best deal to get publicity. Is it realistic? These prices, execution and stability is vital for the long term.
But David, would you agree that that's what retail brokers are doing? They are showing prices that are not really tradable.
Yeah, that's it. They might be showing prices and you can't actually hit them. It's just a sort of marketing tool to get publicity. But traders are looking for stable execution as well as good pricing.
This just isn't our strategy, so it's not something that we spend a lot of time focusing on. Like, for example, our spread on euro dollar is 1.1. There's cheaper out there. So, but what we generally do, based on our strategy of just knowing our client better and offering a superior product, is we know that our industry, most clients have 2 to 3 accounts. So I know a lot of my clients actually have accounts with David's company. And many other brokers, and we know that over time, to David's point, execution is very important, and if they see 1.0, they expect to see that on day 1 of joining and day 101 of joining. So sometimes the execution can get poor over time because they know they got you in and they can change the pricing. We don't play any of those games, and we have been the benefactors of receiving clients who do have accounts elsewhere. They come in, though, because they know, all right, 1.0 is not the tightest spread in the world. There's tighter out there, but they're not going to play games with me over time. I've heard good things about them from the Facebook group I'm in or the WhatsApp group or whatever, and so on and so forth. So I can't give you any technical details here because this is not a game that we're playing.
I actually agree with that when it comes to especially the younger generations of traders. We see this a lot, that they are actually very quick to compare between different brokers and see what they are getting from each. And it's not just what's shown on paper, it's actually, what are the results when they are actually trading. And especially when we talk about the millennials and so on, they are very quick to jump ship from one place to the other. They're not going to sit around and be loyal like maybe older generations. So I completely agree that it's very important to actually show an offering that it's consistent and that actually it's tradable. This is very, very important. And from our side, we've always put a lot of effort into our bridging and connectivity engine to have a lot of different statistics that show that actually, to see when you're dealing with multiple counterparties, what's the behavior, what's the hit rate, what's the slippages, the rejection rates, partial fills, and so on. And I think that this is very, very important.
Okay, and maybe an extension of that is, maybe we can go to Maria on this one in terms of tooling that you're providing to your clients. What defenses are you giving them in their ability to do their job? You've got rules-based approach. You can profile a client. It can be the size of the deposit. It can be the time of the day they trade. It can be a whole number of different variables that a broker can look at. But when it comes to sort of arguably abusive trading practices or people who are trying to get an edge, it could be latency, it could be any other type of arbitrage. What sort of tools have you guys got that you can offer to your broker clients that enable them to identify this stuff, hopefully before they get run over?
Definitely. I mean, it comes down to what we were saying before as well with regards to profiling, capturing that data, being able to kind of see previous behavior to be able to then say, what are those patterns? What does it look like? And then being able to understand back on their processes or their policies of which way they would end up setting up criteria to limit that exposure. It can be along the lines of, as you said, looking at profiles. A lot of it for us goes as well with regards to events, market conditions in the sense of announcements, news, from there. Now, as far as actually protecting themselves and being able to capture all that data, it again is just within the system of being able to track your clients, seeing how it is, so what kind of patterns they're following, and then being able to set the criteria accordingly.
Okay, thank you. Anyone else want to comment on that, David?
Yeah, I mean, Vantage have been around long enough, so we've got, a data warehouse of historical data so that we can, drill into that to look for behavioral patterns, to train staff, to have risk analysts look for suspicious activity. Your first line of defense when you onboard a client is vital, that, you're looking for, with your sales team, for anything that's suspicious when you onboard them, that could be, a potential toxic trader. I mean, they can do a lot of damage to your P&L if you onboard the wrong client, and also do a lot of damage to your liquidity partners. So it's vital that you look for behavioral patterns, you keep monitoring the client for any suspicious activity, and you have that important first line of defense when you onboard someone, that you're doing your due diligence on the client when you onboard them.
I totally agree with that. I would say that during the onboarding, it's important to know the demographic of the client. As we see from our experience, some demographics shows that they're more aggressive traders, some of them more abusive, so it's important to know your client and to monitor accordingly their flow to avoid the toxic flow.
Yeah, we do. We run proprietary tech that manages for us. And like David said, we use a customer data platform that takes in the obvious things like demographic information, but also the less obvious stuff. So when we have clients come in, let's say a bunch of clients come in from Turkey, we know the exact city they're in, we can even know the province they're in, and so we can start understanding which school of fish we're looking at right now, and we can start assigning these different, just to use an analogy, these fish into that school, understanding who's swimming in the same direction. And so we look into that. We look into kind of 3D dimension levels of data points too. We can even look into what trading groups they came in from, and we can actually see those groups. And so I think it's using a lot of data points and then having somebody in-house. If you don't use a third-party product, obviously, having somebody in-house to organize that so it's actually useful information. But it's definitely doable. We do it in-house. We have a limited number of staff. We're pretty lean, but it's something you can do in-house, which is what we do.
Okay, Cristian, I think you wanted to...
Yeah, I want to say that I agree with everyone, what they said, and I believe that from our side, we've put a lot of focus on that in providing a lot of different real-time data points and criteria that take into account the entire history of the trading, some functional and non-functional requirements as well. And what's important, though, what I found is that the trading behavior of specific customers can change very fast, really, from one day to the other, really. So it's very important to be able to track this on a customer-by-customer level, but in real time as well, and to have these systems and the controls, the technology in place, basically, that can take decisions almost in real time in that regard. And it's important to also have the flexibility and the scale needed in order to be able to route the executions on a per customer basis individually, because you wouldn't want to have a system that reacts and changes the trading terms across the majority of your customers or all of your customers that have done nothing suspicious, nothing wrong, and basically damage your reputation and experience for all of them. So that's very important, and building in-house technology is one way to look at it, or outsourcing to someone that can provide that. And it's very important, though, to have a proper dedicated setup that you can really, truly control. That's what I'd like to add.
Okay, thank you. Let's move on away from the risk management that we've been talking about now, because I know one subject came up on our pre-panel exchange, and it's the one about the risk versus the counterparties. And I guess we've seen a fairly interesting development in the last few days within the crypto space, a fairly collateral problem that's, we're yet to see the full effects of the contagion. But maybe we could just go around the room and ask some questions about how do people look at their counterparties? How often are you evaluating the people you're doing business with? If I take our example at ISAM Capital Markets, we have two main street side clearers. They are multi-billion-dollar organizations. Our group risk teams are studying their balance sheet every single day, their credit rating every single day, their share price every single day. And it would be interesting to understand, how your experience with the retail brokers. What are they doing to check that they're getting the right counterparty against whom they're actually trading, if indeed they are externalizing any of their business? David, maybe I can go to you with that one to start with.
Keeping an eye on working with your counterparties is key. You have to have good relationships with your counterparties. As you say, monitor them all the time, do your due diligence, not just for your own benefit as a company, but also, the regulator is demanding that, you work with your counterparties and do your due diligence on them, and you have credible counterparties. So it's absolutely vital. We've all seen in the crypto what's happened. Black swan events are very difficult to keep, to predict. But you have to hopefully do your due diligence, have deep liquidity pools, and be working with different counterparties to manage your risk, and have backups with other liquidity providers. But key is your relationships and working with them all the time and keeping in touch and monitoring. That's vital.
Despina, do you have any view on that at all?
Yes, I would say that we've seen from the FTX collapse that it's very important to assess the counterparty risk. These types of risks are often overlooked. We tend to look only at the market risk and the P&L and so on. But we need to be very careful and assess all our counterparties. There needs to be good corporate controls inside all the organizations. We've seen that from the collapse of the FTX, that there were no governance controls at all. There were conflicts of interest. So we need to have a very good due diligence and monitor, as the rest of the panelists said.
Michael?
Yeah, we do stuff that you mentioned. So when we onboard a new provider, we would obviously look at their to the best of our ability, we will look at their credit worthiness. If they're private, there's obviously more challenges there. So we have a kind of a guide or a spreadsheet that shows us that we update, kind of monitoring the risks of each party that we work with. It's probably what you would expect. We also have. I think this is actually on the top of clients' minds too. They want to know, I've got money with your company, were you related to FTX? Did you have exposure to FTT tokens? So this topic has actually come up with customers, and not just internally discussing who we work with. And so we try to be very quick to react to that, to talk to clients about how we're audited and how solvency and financial and capital ratios are reconciled every single day and monitored, and the importance of regulation. So it's not something that we not only just discuss internally, but we've actually gone out of our way now to discuss it with customers more, and we're spending money and time on kind of strengthening that conversation, and even offering account insurance up to £1 million in about a month. And so it's a very topical point right now that you have to have a good answer for, especially if you're dealing with clients and they're depositing their money with you.
Maria, I mean, I'm not sure how that sort of counterparty risk would come, but you must have some risk.
Exactly.
Maybe against some of your clients not paying their bills.
No, but I was going to say that just with regards to counterparty risk, I think it is that there is this lack of awareness. And I think we talk about due diligence, but if anybody had done their due diligence on FTX, it wouldn't have come up anywhere. I mean, it wasn't so much that you had people saying that we worked with them, we did our due diligence, we tried to get to know, and it just came as such a surprise. So I think what it comes back down to with regards to this is more along the lines of making sure that regulators or whoever is making more of an effort to make sure that this is more transparent, to make sure that it's easier for people, for brokers, for companies to be able to do their due diligence.
Cristian, any thoughts on counterparty risk for us?
Well, same as Maria, I'm a little bit on the side on that. We're not a broker. However, what I'd like to say that, in terms of risk, it's very important to diversify and never depend your business on just one entity. And we at Centroid have always been about that, providing our customers with options. As a connectivity provider, that's what we do. So we've done a lot of integrations, and we continue to do so in order to make sure that everyone that's using our technology can very easily switch, can have multiple counterparties. And I would say that if we talk in general about counterparties, it's not even just at the level of, let's say, trading counterparties. It's all the way to all the different components, even trading platforms for that matter, right? So it's very important to be able to have a diversified setup and not depend on one single entity. And what we've seen, especially from the average retail broker, it's not that they don't really have, let's say, awareness in terms of counterparty risk. It's just that it's very challenging to manage a setup with multiple counterparties. And I think that it's up to us, the technology providers, to step in and provide them with a unified view with different options and so on in order to allow them to be able to run such setups.
So you're really saying that the way forward is for people to be agnostic. When it's a technology vendor, they've just got to be give the client the flexibility to have that choice and plug in LPs, plug in whatever else they need to manage their business, right?
Absolutely, and even to the point that you should have different technology providers, not just one.
Sure. Okay, well, we're going to wrap now. We're coming out to the end of our time. Thank you very much to everyone, and hope it's been of interest. Cheers.